Hello everyone, welcome to The Financial Prophet. I'm Viktor Derginov. I'm very glad to see you here, and in today's video we will discuss our weekly profit report. In today's video, we're going to talk about Nvidia's upcoming earnings, crucial market data, including the core PCE on Friday, and much more. Stay with me to beat the market and stay ahead of the curve. So things seemed to be going well lately. The S&P 500 and other major market averages were trading around all-time highs, seemingly on the verge of a breakout. Yet, all of a sudden, stocks basically just crashed on Friday, February 21st. While the S&P and the Dow Jones Industrial Average declined by about 1.7% each, the Nasdaq took an especially hard beating, getting slammed by about 2.2%. Now, there was a slew of less than stellar economic data recently, and we received several more negative nuggets of economic data on Friday. For instance, existing home sales slumped more than expected, tariff worries were reported to hit some business surveys, impacting inflation expectations, and more. Uncertainty appears to be creeping back into the market, and more questions are popping up asking whether the market is indeed on solid footing here, or is the market at risk for another considerable correction, or perhaps even a more prolonged bear market type of decline? Let's take a look at the chart here. So the market appeared relatively constructive technically recently. It was consolidating around the 6100, 6150 resistance range, seemingly looking for a breakout in the near future. Instead, however, the market put in a lower high on the RSI, implying potential worsening technical momentum. Now, the initial support is right around 6,000 to 5,950 here. And if the S&P 500 starts penetrating this level, the probabilities increase for a full-blown 8 to 10% correction decline. The probability for an 8 to 10 correction here may be about 20%. But that chance will increase substantially to 30 to 50% or higher in the near term if 6,000 to 5,950 support breaks down. Now, an 8 to 10% correction would take the S&P 500 all the way back to around 57 to 5,500 support, likely creating an excellent buying opportunity around the instrumental 200-day moving average support level. However, I don't view this as a base case scenario. I view this as a bearish case outcome. In a base or a bullish case scenario, the market may consolidate around 6,100 to 5,900, and price action could persist around the 50-day moving average support without having to test substantially lower levels like 5,800, 5,700, or perhaps even 5,500. Having said that, we do have to consider that some of the recent data has been worsening. Now, one of the worst things the market could ever see in the US is a recession, deflation, or both. Markets hate uncertainty, but given the recent tumultuous political environment, uncertainty about the well-being of the US economy seems to be on the rise again. There's growing concern about tariffs impacting business confidence, expansion, and growth in general, as well as inflation, consumer confidence, and other crucial aspects of the U.S. economy. Also, there seems to be some split about the economy as people closer aligned to the Democratic side of the political spectrum believe things are much worse than those that are on the right. Now, this is also true with the independents and mostly with the Democrats, is that their perception is that with all the changes occurring in Washington now, and with Donald Trump in the White House, and with Elon Musk in Doge, their perception is that things are becoming worse and worse, and in the near term, this phenomenon could reflect negatively on consumer spending and other crucial aspects of the economy. So that's something that we should definitely keep in mind. Just since the start of February, we've witnessed factory orders, ISM, jobless claims, consumer sentiment, oil inventories, retail sales, housing starts, and other homes data, inflation, and other crucial data points coming in higher or worse than expected, in part or maybe mostly due to this dynamic of part of the population, a significant part of the U.S. population, feeling in some respects isolated, or in some respects basically just not feeling very good at the time. This dynamic is showing us that the market may be going through a transitory slowdown, potentially due to the aggressive post-inauguration initiatives, which may be impacting a portion of the consumer base and others' sentiment negatively. We should remain mindful of this dynamic, especially in the near term, as it could lead to more transitory market turbulence during this adjustment and transition phase. So, yes, we should definitely be mindful of these factors. Nonetheless, I view the current atmosphere as a temporary transition style phase during which people really have to come to grips with the new reality, the new economic standard, the new political dynamic, and basically things are going to look much different in the next 4 years than they looked during the previous 4 years. And I guess the sooner we all accept this fact, perhaps the better we all will be. Okay. Now, on Tuesday, we will receive CB consumer confidence, which is interesting as we can see how it stacks up to the recent Michigan consumer sentiment reading, which came in substantially lower than anticipated last week. Also, oil inventories and new home sales will be important data points on Wednesday. On Thursday, we will receive durable goods orders, Q4 GDP, and jobless claims. So Thursday is going to be a very busy day. And of course, on Friday, we will receive the most critical reading of the week, the core PCE inflation reading. This will be very crucial reading as the market would like to see the core PCE around 2.8%. Now, despite the recent CPI moving up to 3%, I want to draw your attention to truflation, as truflation has recently decreased from a transitory spike to over 3% around December and January, down to just around 2.3% more recently. Therefore, the mainstream government inflation gauges may also follow truflation lower in future months, seeing that truflation is really the leading inflation indicator as opposed to the PCE and the CPI being more of the lagging inflation indicators. Still, this leaves some uncertainty for the core PCE this month, which is scheduled to come out on Friday. So it could come in around 2.8%, which would be acceptable for the market. However, a move to 2.9 or 3% may be observed with increased skepticism and could create a negative knee-jerk reaction from the market if we do see inflation coming in higher than expected, as it would impact the rate cut probabilities negatively. Now, I want to draw your attention to the silver lining in all of this data that's been coming in slightly worse than expected. Now, the silver lining is that as the data worsens, the probabilities of a rate cut occurring sooner rather than later increase. In a way, we can view this phenomenon as bad news being considered as good news again. So let me just draw your attention to this. There's now nearly a 2/3 probability that we will see at least 125 basis point cut by June. Last week, the odds were much lower, about 50-50. Moreover, there's now an overwhelming probability that we will see 1 or 2 25 basis point cuts by September, approximately an 84% probability. Again, substantially higher than what we observed just 1 week ago. So what we're seeing here is that as the data points worsen a little bit, the probabilities for a rate cut occurring sooner rather than later are increasing. So we're getting more probabilities that the Fed will cut sooner, which is actually bullish for the economy and the stock market. So again, that's why I'm saying that the negative news may be looked upon as not being so negative because it's actually going to lead the Fed to cutting sooner rather than later. So the Fed put is kind of just back on the table in a way. And again, this dynamic illustrates that we could see more monetary support from the Fed sooner rather than later, and we could see more rate cuts this year than the market anticipates. This dynamic implies that we may have a Fed put beneath the market. If the data continues worsening, probabilities for rate cuts should continue increasing, which is what the market wants. However, we must walk a fine line here in order to avoid a recession. I believe the million-dollar question here is, how likely is a recession? Now, in my view, a substantial recession isn't very likely in the next 12 months. However, we have to consider that we are in a more volatile and uncertain environment than is usually considered typical for the market. Therefore, more scenarios are plausible. And one of the more bearish scenarios is a possible recession within the next 12 months. Now, a recent survey found that only about 26% of economists expect a recession by the end of 2025. JP Morgan said its 12-month recession probability at only about 20% relatively recently. Now, while we should consider that there may be increased noise and increasing calls for a recession due to Donald Trump and the global shakeup effect and due to Elon Musk and Doge, still, according to my calculations and according to other reports that I've seen and other estimates, the probability for a recession in the next 12 months may only be around 10 to 20%. So I want to leave this analysis on a more positive note. So we probably should discuss some of the positive catalysts that are approaching, because I noticed that there's so much negativity in markets, and market participants, especially now with with the changing dynamic in Washington, so many people just want to be negative and they want to bet against the U.S. economy. They want to bet against Donald Trump and this presidential administration for whatever reason. But I remain an optimist. I am a glass half full kind of guy all the time. So I want to leave this analysis on a positive note. So while the market has received a hefty dose of negativity and negative news flow lately, we could see some more positive developments as we move forth. Despite the exact timeline not being announced, we could see tax cuts announced relatively soon, which could be a massive catalyst for stocks and other risk assets. In addition to tax cuts, deregulation, targeted infrastructure spending, and other fiscal stimulus could get announced, which could provide a confidence boost to markets very soon. This dynamic, as well as the likelihood for more monetary stimulus, should contribute to the favorable backdrop in 2025 and 2026. Now, perhaps most importantly, we continue seeing solid performance from corporations, with 88% of major companies beating their earnings estimates last week. We witnessed similar solid earnings and robust guidance from many top corporations during this earnings season. Nvidia's solid earnings could be next, and they could enable markets to move higher this week, as the AI giant could illustrate substantial demand for AI infrastructure in future years. I just want to address Nvidia's earnings briefly here, because they will come soon, and it is really a major market event. So Nvidia is set to report earnings this week on February 26th after the bell. The market expects about $38.1 billion in sales from Nvidia, and the consensus estimate is for 84 cents in normalized EPS. The top line number will be especially important here, as the market will look for signs of continued growth, especially in the lucrative enterprise AI GPU segment. While Nvidia guided to only 37.5 in sales for Q4, Nvidia often sandbags its forecasts, making it easier to provide better than anticipated results for the AI juggernaut. Therefore, Nvidia could provide 38 to 30 billion in sales, while potentially delivering a minor beat on the EPS side. Guidance is particularly crucial, as the market wants to see continued robust demand for Nvidia's AI products, despite the recent DeepSeek and other concerning events. The high expectations, I anticipate Nvidia can provide another constructive earnings report, which should support its stock price trajectory, and perhaps most importantly, the trajectory of other high-quality AI stocks. So basically what I'm looking for from Nvidia is a beat, top and bottom line beat, as well as a relatively robust earnings report. It may not be, it may not provide blockbuster guidance, but the guidance should be good enough to provide, first of all, a boost to Nvidia stock, as well as a boost to the overall semiconductor AI segment, and the overall market and tech segment in general should get a positive boost after Nvidia provides another stellar earnings report soon. Now, this dynamic illustrates that. Now I'm getting back to the article and back to just the general earnings, not just Nvidia's, but general earnings coming in better than expected. So this dynamic illustrates that the private sector remains healthy, and we could see more growth increases as AI and other drivers propel innovation and growth in the coming years. Due to these and other bullish factors, and despite the possibility for more near-term volatility, I am keeping my year-end S&P 500 target at 7,000. Now, having said that, let's talk about the portfolio strategy a little bit. Now, I've recently increased the all-weather portfolio's cash holdings to about 5%. If once we include the exercised Palantir CCD position, the all-weather portfolio's cash is holdings are at about 6.5% now. Now, what I plan to do is I plan to decrease more risk and increase more cash if the price action continues worsening and begins threatening major support levels from here. However, I think it's very important to note this fact that if we do not have a substantial correction here, the path of least resistance remains higher, and I want to be along for the ride. Therefore, I remain bullish in many high-quality stocks and lucrative segments here, and I plan to put my cash position to work if the market stabilizes here, and we see that it is probable that we're going to see this uptrend continue. So, several stocks on my immediate and near-term buy list include Nvidia, AMD, Qualcomm, SentinelOne, Broadcom, Snap, Amazon, Tesla, MongoDB, Oklo, Vistra, Axon, Hecla Mining, and other high-quality companies. I am also warming up to including more oil and energy names in the all-weather portfolio. With oil above 70 and potentially moving higher, I like, badly beaten down stocks like Devon and like Apache and like Schlumberger, and other undervalued oil and oil services stock. Digital assets have also been in pullback mode, but we may see another round of upside if Bitcoin breaks out above 100,000. So I may get into some more digital assets if Bitcoin starts to move higher again. Gold, silver, and other high-quality industrial and material stocks appear attractive here and may have more upside as we advance. So really, there are many sectors that it's not just technology, and it's not, there's really many diverse opportunities in the market right now. So while there has been some increases in volatility recently, the all-weather portfolio's year-to-date return is at around 5%. So, we've had some volatility recently, and the all-weather portfolio's return declined a little bit from last week's highs, but it's still substantially above the S&P 500s and the Nasdaq's returns. And again, we're just starting this year basically. So due to the solid performance and favorable backdrop, I am keeping my full year return target range at 40 to 50% for the all-weather portfolio. So that's my weekly profit report. Thank you for watching, and please comment if you agree on some elements that we discussed, or maybe if you disagree with me. That's great. In any case, if you enjoyed my video, please click like, share, and subscribe. You can also follow me, Viktor Derginov, at The Financial Prophet, at seekingalpha.com. Thank you very much for watching my video, and have a fantastic day.